This is the hardest truth that most investors will never accept. I need you to stop pretending that the stock market is rational. I need you to stop analyzing earnings reports like they matter. I need you to stop running discounted cash flow models and calculating price to earnings ratios as if those numbers have any connection to what stocks actually do. Because I am telling you right now with absolute certainty that the market you think you understand, the market you learned about in business school or read about in investment books, that market is dead. It died somewhere between the pandemic stimulus checks and the GameStop squeeze. And what replaced it is something completely different. Something that operates on rules that have nothing to do with fundamentals. The stock market is broken. And the sooner you accept that, the sooner you can stop losing money trying to make sense of the insanity. Let me be very clear about what I mean by broken. I do not mean that the market is rigged, though it is. I do not mean that it is manipulated, though it is. I mean that the fundamental mechanism that is supposed to govern stock prices, the idea that a stock's value reflects the present value of future cash flows, that mechanism no longer works. It has been replaced by something else entirely, by momentum, by narrative, by collective belief, by memes. The market has become a game of musical chairs, where the only thing that matters is whether you can find someone willing to pay more than you did. Not because the company is worth more, not because earnings are growing, but because the story is compelling, because the momentum is strong, because everyone else is buying. This did not happen overnight. This was a process, a gradual erosion of fundamentals that accelerated during COVID and became permanent in the years after. Let me walk you through how we got here. In March 2020, the world shut down. The economy collapsed. Unemployment went from 3.5% to 14% in a single month. GDP contracted at an annualized rate of 31%. It was the fastest, sharpest economic contraction in history. And the stock market crashed. The S&P 500 fell 34% in 5 weeks. It looked like 2008 all over again. It looked like the beginning of a multi-year bear market where stocks would grind lower as the economy struggled to recover. That is what fundamentals would have predicted. That is what history would have predicted. But that is not what happened. Because the Federal Reserve, the Treasury, the politicians, they decided that they would not allow a depression. They decided they would do whatever it takes. So they printed money, trillions of dollars. The Fed cut rates to zero. They restarted quantitative easing. They bought $120 billion of bonds every single month. It went into the stock market. It went into housing. It went into crypto. It went into NFTs and SPACs and meme stocks. Because when you give people money and there's nothing to spend it on, when the restaurants are closed and the concerts are canceled and the vacations are impossible, they invest it. They gamble with it. And millions of people who had never invested before, who had never opened a brokerage account, suddenly had Robinhood on their phones, suddenly had commission-free trading, suddenly had access to options and leverage and fractional shares. And they started trading, not investing, trading, gambling, speculating on whatever was moving. And what was moving was not the companies with strong balance sheets and growing earnings. What was moving was the companies with the best stories, the best narratives. Tesla was not just a car company. It was the future of transportation. It was saving the planet. Elon Musk was a genius, a visionary. Tesla went from $80 to $400, then it split. Then it went to $400 again. A $1.2 trillion market cap for a company that sold fewer cars than Ford. But fundamentals did not matter. The narrative mattered. The belief mattered. The momentum mattered. GameStop was a dying retailer in a dying industry. Video game stores when everyone buys games digitally. The stock was $4. The fundamentals said it was going to zero. The hedge funds shorted it. But then Reddit found it. Wall Street Bets found it. And they decided that fundamentals did not matter. They decided that if they all bought together, if they coordinated, if they held, they could squeeze the shorts. They could force the hedge funds to cover. They could drive the price to the moon, and they did. GameStop went from $4 to $483. Not because the business improved, not because earnings increased, because millions of retail traders decided to buy. Because the narrative was us versus them, David versus Goliath, retail versus Wall Street. And the collective belief, the coordinated buying, overwhelmed the fundamentals. And when GameStop worked, when regular people made millions of dollars buying a stock that fundamentals said was worthless, it changed everything. It broke something fundamental in how markets work. Because it proved that fundamentals do not matter if enough people believe the story. It proved that coordination beats analysis. It proved that momentum beats valuation. And once that lesson was learned, once that Pandora's box was opened, it could not be closed. Every stock became a potential GameStop. Every narrative became a potential 10-bagger. And the market stopped being about investing in businesses and started being about trading narratives. Look at what happened in 2021, the peak of the insanity. SPACs, special purpose acquisition companies, blank check companies with no business and no revenue, they went public at $10 and traded to $50, $100, $200. Why? Because a celebrity endorsed it. Because a famous investor was involved. Because the story was electric vehicles or space or fintech or whatever the hot sector was. Chamath Palihapitiya became a billionaire taking companies public through SPACs that collapsed 90% after the hype died. But it did not matter. Because by the time the fundamentals caught up, by the time the earnings disappointed, the insiders had already sold. The retail investors were left holding the bag. But new retail investors kept coming. Because they saw the stories of people who got rich. They did not see the stories of people who lost everything. NFTs, non-fungible tokens, digital images that you could right-click and save. But people paid millions of dollars for the original Bored Ape Yacht Club CryptoPunks. Digital art that had no intrinsic value, no cash flows, no utility. But it had scarcity, it had story, it had social proof. Celebrities bought them, athletes bought them, and regular people bought them thinking they would flip them for a profit. At the peak, a single Bored Ape sold for $3.4 million today, maybe $50,000 if you're lucky. The fundamentals, or lack thereof, eventually mattered. But during the mania, fundamentals were irrelevant. Crypto. Bitcoin went from $10,000 to $69,000. Ethereum went from $300 to $4,800. Dogecoin, a literal joke coin created to mock crypto, went from 0.02 to 0.73, a 36,000% return. Why? Because Elon Musk tweeted about it, because Saturday Night Live was going to mention it, because the story was that Dogecoin was going to $1 to $10 to the moon. There were no cash flows, there was no business, there was no fundamental value. But there were millions of believers, and their collective buying drove the price, until it did not, until the narrative broke, until Elon went on SNL and called Dogecoin a hustle, and it crashed 70% in 3 days. This is the pattern. This is how the broken market works. A narrative emerges, a story, electric vehicles, artificial intelligence, psychedelics, plant-based meat, space exploration, whatever. The narrative spreads on social media, on Reddit, on Twitter, on TikTok. Influencers promote it. YouTubers make videos about it. The momentum builds. The price starts moving, and the algorithms notice. The high-frequency traders notice. The momentum is confirmed. More buying. Higher prices. FOMO kicks in. Fear of missing out. Retail investors pile in. They do not read the 10K. They do not analyze the balance sheet. They just buy because the stock is going up, because everyone is talking about it, because they do not want to miss the next Tesla, the next GameStop, the next 10-bagger. And the professionals, the hedge funds, the institutional investors, they see what is happening, and some of them fight it. They short the overvalued stocks. They bet on fundamentals reasserting, and they get destroyed. They get squeezed. They get margin called. Because in a momentum-driven market, being right about fundamentals does not matter if you are early. The market can stay irrational longer than you can stay solvent. So the professionals adapt. They stop fighting it. They start trading the momentum. They start monitoring Reddit. They start tracking social media sentiment. They start using AI to analyze trending topics. They abandon their DCF models and start trading like the retail crowd. Because that is what works. That is what makes money. Not being right about earnings. Being right about what everyone else is going to buy. And the central banks, they enabled all of this. They created the conditions for this madness. By keeping interest rates at zero, they made it impossible to earn a return in bonds or savings accounts. They forced everyone into risk assets, into stocks, into crypto, into anything that might generate a return. And by printing trillions of dollars, they ensured that there was infinite liquidity chasing finite assets. The laws of supply and demand guaranteed that prices would go up, not because the assets were worth more, but because there was more money chasing the same assets. But then, something changed. In 2022, inflation arrived. Not the good kind of inflation where prices rise gradually and predictably, the bad kind. The kind where gas hits $5 a gallon, and groceries cost 20% more, and rent is unaffordable. And the Fed panicked. They realized they had printed too much. They realized they had to tighten, so they raised rates from 0% to 5.25% in 18 months, the fastest rate hike cycle in history. And they started quantitative tightening. They stopped buying bonds, they started selling, they started draining liquidity from the system. And the broken market broke in the other direction. The stocks that went up on narrative crashed, the SPACs collapsed, the NFTs became worthless, the crypto crashed. But here is the problem. Here is why the market is still broken even after the crash. The fundamentals still do not matter. The market is still driven by narrative and momentum. It is just that the narratives changed. In 2020 and 2021, the narrative was growth at any price. Disruptive technology, the future. In 2022 and 2023, the narrative became inflation, recession, the Fed, and now in 2026, the narrative is AI. Artificial intelligence is the new narrative that is driving the market. Every company is an AI company. Every product has AI. Every earnings call mentions AI 50 times. And the stocks that have AI in the story, they go up, regardless of whether the AI is real, regardless of whether it generates revenue, regardless of whether it will ever be profitable. NVIDIA went from $150 to $800 because AI needs GPUs. Microsoft went from 250 to 420s because they have Copilot. Google is up because they have Gemini. The fundamentals, the PE ratios, the valuations, they are absurd. NVIDIA is trading at 60 times earnings, but it does not matter because the narrative is that AI is going to change everything, that AI is a $7 trillion opportunity, that we are in the early innings of a transformation as big as the internet. And maybe that is true. Maybe AI will change everything. But even if it does, even if the narrative is correct, it does not mean the valuations are justified. It does not mean that NVIDIA is worth $3 trillion, but in the broken market, it does not matter. What matters is the story. What matters is the belief. What matters is the momentum. And this is why I say the market is broken. Because the mechanism that is supposed to correct overvaluation, the mechanism where rational investors sell overpriced stocks and buy underpriced stocks, that mechanism does not work anymore. Because there are no rational investors. There are only narrative traders, only momentum followers, only people trying to get in before the next leg up. And as long as the narrative holds, as long as the story is believed, the price can go to any level. It can disconnect completely from earnings, from cash flows, from any fundamental metric. And it will only correct when the narrative breaks, when the story changes, when the collective belief evaporates. And you cannot predict when that happens. You cannot model it. You cannot analyze it. It is pure psychology, pure sentiment, pure madness. So what do you do in a broken market? How do you invest when fundamentals do not matter? You have a few options. Option 1, you can refuse to participate. You can stick to your fundamentals. You can buy undervalued stocks with strong balance sheets and wait for the market to come to its senses. And maybe you will be vindicated. Eventually, in 5 years, in 10 years, when the narratives exhaust themselves and fundamentals reassert. But in the meantime, you will underperform. You will watch other people get rich trading memes while you sit and value stocks that go nowhere. And you will question yourself. You will wonder if you are wrong, if the market has changed and you have not adapted. This is the Warren Buffett approach, and Buffett himself has struggled in the last 5 years because the broken market does not reward patience and fundamentals. It rewards momentum and narrative. Option 2, you can embrace the madness. You can trade the narratives. You can buy whatever's going up. You can follow the momentum. You can monitor social media and jump on the trends early. You can use technical analysis and chart patterns. You can trade like a gambler instead of an investor. And maybe you will make money. Maybe you will catch the next big trend. Maybe you will get in early on the next AI stock or the next meme stock, but you will also get burned. You will buy at the top. You will hold too long. You will believe the narrative after it has already broken. And you will lose because trading narratives is a game of musical chairs, and you do not know when the music will stop. Option 3, you can hedge. You can accept that the market is broken and build a portfolio that survives in both scenarios. You hold some growth stocks for the momentum. You hold some value stocks for when fundamentals matter again. You hold some cash for when opportunities arise. You hold some gold and silver for when the whole system breaks. You diversify. You protect yourself. You do not go all in on any single narrative. You do not bet the farm on fundamentals or momentum. You spread your risk, and you accept lower returns in exchange for lower risk. This is the prudent approach, the survival approach. But it is boring. It is unsexy. It does not make you rich overnight. But here's the truth that nobody wants to hear. The market being broken is not temporary. This is not a phase. This is not something that will revert to normal when the Fed stops printing or when interest rates normalize. The market is permanently changed because the structure has changed, because millions of retail investors have permanent access to commission-free trading, because social media is permanent, because the ability to coordinate and spread narratives at the speed of light is permanent, because the algorithms that trade momentum are permanent. The broken market is the new normal, and it will only get more broken, more narrative-driven, more divorced from fundamentals, because that is the direction of technology. That is the direction of human psychology at scale. The only thing that could fix the market, the only thing that could force a return to fundamentals, is a crash so severe, so devastating, that it destroys the belief in narratives. A crash that wipes out the retail traders, that bankrupts the momentum funds, that forces everyone to care about earnings and balance sheets again. And that crash is coming. It is inevitable. Because every bubble eventually pops. Every mania eventually ends. Every broken market eventually breaks completely. And when it does, when the crash comes, it will be worse than 2008. Worse than 2000. Because the leverage is higher. The speculation is more extreme. The disconnect from fundamentals is more severe. But until that crash comes, until the broken market breaks completely, you have to play the game. You have to trade the narratives while protecting yourself from the downside. You have to accept that fundamentals do not matter until they suddenly do. You have to accept that the market is driven by psychology at scale, by stories, by memes, by collective delusion. And you have to position yourself to survive when the delusion ends, because it will end. It always does. The question is when. And whether you will be ready. The stock market is broken. Just accept it and trade accordingly.